Hi, this is Chuck Stull, continuing our discussion of the beer industry. In this video, I'd like to discuss market structure because the beer industry provides an interesting example of structural change. In the last half of the 20th century, the beer industry in the United States went from unconcentrated to highly concentrated. If we look at the Herfindahl Index in 1947, it would be 140. By 1998, the Herfindahl Index was 2,789. This is a striking increase in a relatively short period of time. By the end of the 20th century, we had a tight oligopoly of big brewers, much more concentrated than it was 50 years earlier. But I'd like to start even earlier. Initially, beer markets were local. There was no national market, and there were over 4,000 breweries, all serving local beer. Now, as we looked at in our last video, bigger breweries are more efficient because of economies of scale. But transportation costs initially limited the market size. Beer is mainly water, and water is heavy. And unpasteurized beer can spoil fairly easily. Those two things makes transportation costs very expensive. So for centuries, beer had to be sold locally, and that limited the size of the brewery to whatever the local market was. Breweries couldn't be as big as they would need to be efficient, and instead they simply were as big as they needed to be to serve the local market. Now, in the late 1800s, two technological innovations changed the brewing industry. One was the invention of the crown bottle cap in 1892. So this was a superior technology for sealing the bottle, and that did allow further shipment. And the second important technological change was more national and applied to many other industries, and that was the development of the National Railroad Network, right, which had taken place from like the mid 1800s to the late 1800s. So these two innovations together made a dramatic reduction in transportation cost and allowed brewers to ship outside of their local market. And that meant that some brewers could take advantage of economies of scale. And so there were some Midwestern breweries that took advantage of these changes, and these were known as the shipping breweries. So Pabst and Schlitz, based in Milwaukee, Anheuser-Busch in St. Louis, sold locally, but they also shipped to the East Coast cities. Now, transportation costs aren't free. Even though they were reduced, the companies still needed to recover their costs. So if we look at the production cost at the brewery, that's going to be so much per keg. But then as we transport it by train, we have to pay the mileage, we have to pay the freight. And so as we move farther and farther away from the brewery, the total cost of producing and shipping the beer gets higher. So the transportation costs, while no longer prohibitive, they did make these beers more expensive than the locally produced beers. So initially, the shipping brewers had to charge a premium price in order to cover the transportation costs. And that created a premium image in consumers' minds, the belief that a high price was equated to high quality. And so the first premium beers, Pabst Blue Ribbon, Budweiser, and Schlitz, because they were more expensive, were seen as better than the cheaper local beers. Now, over time, these shipping breweries or national brewers grew in popularity, and they were able to invest in larger, more efficient breweries, and that led to a decline in the small breweries who operated at a cost disadvantage. And the national brewers had fully taken advantage of the economies of scale. That meant their growth could really happen rapidly, and eventually the large brewers had cost advantages over the small brewers. Now, transportation costs were still an issue. Shipping from St. Louis or from Milwaukee offset the advantages to some extent of the economies of scale. But eventually, the national brewers grew large enough to support multiple breweries of efficient size. So rather than build more capacity in the Midwest, they established new breweries close to the consumer markets. So moving production to the East Coast by the mid-century and then later to the West Coast. And this gave the national breweries an even bigger advantage because by being close to the markets, they had lower transportation costs and they still had this premium image and were able to sell their beer at a premium price. And that led to an interesting strategic question. National breweries had a cost advantage and they had an image advantage. So should they take higher profits because of the cost, or should they decrease their price? Well, in this particular case, they decided to do both. One thing the national brewers did at this moment was to introduce popularly priced beers or budget priced beers or sub-premium beers. So these were ones that would compete on price with the regional and local beers. So Milwaukee Best, Busch, made by the big brewers, but sold locally at low prices. But that let them, by splitting their brands, that let them keep a premium price and image for their main brands, and they continued to charge a high price for the premium beers for Budweiser or Schlitz or Pabst Blue Ribbon, and they increased advertising. And later they introduced the super premium segment for even higher prices. So now they were charging low prices for the budget beers and high prices for the more advertised and more attractive premium beers. And the long run result was to squeeze out the local breweries. So let me look at this chart, and there's a similar one in chapter 5 of the textbook. And let me remind you of a couple things as we're looking at that. The minimum efficient scale is something over 4 million barrels. So really only the bottom row would be the breweries of efficient size. And you can see in 1959, there were only 2 breweries big enough to take full advantage of those economies of scale. Now, if we look at the top row, we can see in 1959 there were lots of small brewers. Right, the tiniest ones are left out here. We're just looking at the ones that are over 0.01 million barrels up to a million. But you can see it went from nearly 200 down to a low of 18 in the early 90s, and then rebounded up over 100 by the 2000s. We'll come back to that because that really is a different segment of this market. But if we look at the middle 2 rows, we can see a decline in the number of mid-sized breweries. So we look over time, those 1 to 2 million went from around 20 to just a couple, and the 2 to 4 million, we can see a little bit of increase as some of them we had some growth in the 70s and 80s, and then they shrank down as well. And then most of the breweries, most of the growth was in that large, efficient size breweries, the ones over 4 million, the ones who were taking full advantage of the economies of scale. And you can see that their numbers increased tenfold over this time period. So eventually, the U.S. industry became dominated by 3 big brewers, with Anheuser-Busch being the biggest. Now, unlike some other industries, mergers played a very small role in the consolidation or concentration of the beer industry. And some of this has to do with antitrust law. In 1958, Anheuser-Busch bought a small Miami brewer known as American Brewing. The government challenged that on antitrust grounds, and again, this is in amongst the strictest eras for merger enforcement. And the court found in favor of the government, found against Anheuser-Busch. They required them to split out American Brewing and sell it, and they restricted mergers by Anheuser-Busch for the next 5 years. In the same year, Pabst acquired Blatz. These are two Wisconsin breweries, and the government challenged that. Um, Pabst lost the case, and it was looking very specifically at Wisconsin as the relevant geographic market. And they were, as a result of that case, a result of being found guilty of violating Section 7 of the Clayton Act, they sold Blatz's assets to Heilemann, to a smaller brewery. Now, after these cases, for the most part, national brewers grew by internal expansion, not by acquisition. Now, smaller breweries, the regional and local breweries, were allowed to merge. And as time went on, as the national beers squeezed out the locals, because the national beers had the better image and lower production costs, many of the small firms um, merged with each other. And these were essentially unchallenged. Right, one of the defenses for antitrust in merger is if the firm was going to go out of business anyway, it would not reduce competition. And so many of these firms weren't going to make it. They were struggling, and this was a way um, to gracefully leave the business. So we had lots of brands that were um, purchased by other companies. Um, because the regional brewers were too small to compete. So in the 80s and 90s, many of the smaller companies joined together, Heilemann, Stroh, Schlitz, and yet they still couldn't compete effectively. Now, some brands, like Pabst, were contracted to other firms to brew, and that was the rise of the virtual brewer. And so that's a beer that still exists, but they are outsourcing all of their action. So overall, this was seen as um, just trying to get rid of these firms that were too small to compete, and there wasn't antitrust action brought, even though we saw many, many brand names disappearing, at least disappearing as independent companies. So let me look at the companies who were winning here, and these are the big three of the US beer industry. So the big three in the 20th century were Anheuser-Busch, Miller, and Coors. And if we look in 1947, Anheuser-Busch out of St. Louis um, was already bigger, but it was tiny compared to where it was by the end of the century. Right, to start with, only 4% of the market share. By the end of the 20th century, about half the U.S. market. Now, Miller had a big jump in growth after they were acquired by Philip Morris. Um, and Coors initially was shipping only locally in Colorado, and then became late to ship to the national markets, but eventually became the third place player. So by the year 2000, we had a very tight, profitable oligopoly, almost equivalent to the domestic car industry. One thing that's really different, though, is that none of these companies exist today as independent firms. Their brands are still there, but the companies are no longer independent, no longer um, based here in the United States. And that leads to our next market restructuring, which was a large wave of international mergers. So there'd been a wave of global mergers um, between Europe, Africa, North and South America, and Asia. In 2002, SAB, or South African Brewing, bought Miller. In 2005, Molson Canadian Brewery and Coors merged. And in 2008, InBev, which was already a consolidation or conglomerate of many different brewers, um, based in Belgium but with Brazilian management, bought Anheuser-Busch. After that, Anheuser-Busch had lots of cost cutting. Um, they had to sell their jets. There was less free beer from employees, fewer secretaries and assistants, fewer private offices. Essentially, there seemed to be A lot of X inefficiency going on, as we might expect in a highly concentrated oligopoly. And those new managers were able to save around $1 billion in costs simply through cutting excess. Now, the biggest merger of all happened just a few years later um, when Anheuser-Busch um, InBev bought SAB Miller. The offer was made in October of 2015 for around $110 billion. Now, due to antitrust considerations, the merger took place over several years. Um, the Department of Justice opened an antitrust investigation after their Scott Hart-Rodino notification. Um, the U.S. market shares, of course, were very concentrated, and a challenge was highly likely. But it wasn't just an antitrust concern in this country. There were also antitrust concerns in the European Union, in China, in Australia, and in South Africa. What the companies did is they sold parts in order to reduce the competitive concerns. So SAB Miller sold its half of its joint venture um, to Miller Coors to Molson Coors for about $12 billion. And that included the global rights to Miller, the own brand name, and the US rights to all of their brands. In Europe, they sold Peroni and Grolsch to Asahi out of Japan, and sold other brands in Central and Eastern European. In China, Snow Beer was sold to China Resources, a government-owned brewery. Essentially, what the companies did is by selling off all of the assets, they said, look, we're not competing with each other anymore. We're not seeing an increase in concentration, and they wanted to get approval. So by divesting many different assets, the merger was eventually approved in the EU, Australia, South Africa, US, and China, and became a huge multinational enterprise. Currently, AB InBev produces the leading brands in many, many countries around the world, and their main focus is on growth in South America, Africa, and other emerging economies. So if we look at the industry today, um, beer industry sales are dominated by huge multinational companies, and many countries, including the US, have no major independent producers. Looking overall at market shares, and these are not national market shares, but global market shares, you can see very highly concentrated. AB InBev, 30% of the world market, Heineken and its associated brands, 11%, Snow Breweries and the Chinese government, 6%, Carlsberg, Molson Coors, 5%, and so forth. So again, very, very concentrated industry, not just at the national level, but at the global level. This has been Chuck Stull looking at market structure change in the beer industry, and we'll be talking about some product differentiation and trademarks in our coming videos. Thanks for listening.